Yo, what is up guys, D Chantilly here, and today we'll be comparing the stocks of Activision Blizzard, Take-Two Interactive, and Electronic Arts. Each of these brands have their fair share of big-time gaming series on the market. Activision Blizzard has Call of Duty, which is currently playing in the background, Overwatch, and Candy Crush. Take-Two Interactive has Rockstar Games that has Grand Theft Auto and Red Dead Redemption. It also has 2K Sports, which has NBA 2K and WWE 2K. And then we have Electronic Arts that has a sports division that has Madden, NHL, FIFA, and I guess you can include NBA Live. They also have franchises like Anthem, Star Wars, and Apex Legends. Now let's start by taking a look at each company's revenue, net income, cash on hand through their previous 3 quarters, and keep in mind that some companies like Take-Two Interactive are already in their fiscal year 2020, so keep that in mind when you're looking at the numbers. Also, a few disclaimers: I am a shareholder in Activision Blizzard and Electronic Arts. Also, all the numbers and ratios are as of November 22nd, 2019. And so without further ado, let's dive right into Activision Blizzard. Let's take a look at their revenue, net income, and some of the things that we can see going forward with the stock and why it may be a good stock to own. And before we start, just know Y over Y means year over year. So when you see me say something like down 15%, just know I'm talking from this time last year to this time this year. And for the first quarter, they did $1.82 billion in revenue, down about 15%. And then for net income, they were down about 11% to $447 million. In the second quarter, they did $1.4 billion, down about 15%. And then for net income, they were down about 18% to $328 million. And then for the third quarter, they did $1.28 billion, down about 15% again. And net income was down about 15% to $204 million. And overall, through 3 quarters, they did $4.5 billion in revenue and had $979 million in net income. And they currently have about $4.94 billion of cash on hand. This has been a really rough year in terms of year-over-year comparisons for Activision Blizzard, but the numbers have been good. The most recent quarter saw them beat on both the top and bottom line, but the concern that I and Wall Street both had was the monthly active user numbers, or the MAUs, which continued to slide to 345 million, which was 39 million less from this time last year. But that's really the only issue that I see with this company. Call of Duty sales are said to be more than $600 million in the first 3 days, according to Forbes. World of Warcraft Classic drove the biggest quarterly increase in subscription plans in franchise history in both the West and the East. The Overwatch League had a sellout crowd of over 11,000 fans as the San Francisco Shock defeated the Vancouver Titans. Those are actually pretty cool names, to be 100% honest, in the grand finals. And that was at the Wells Fargo Center in Philadelphia. The Season 2 average minute audience was up 18%. The average minute audience is defined as the average number of individuals or homes or target group viewing a TV channel, which is calculated per minute during a specified period of time over the program's duration. And then we have King, which is the mobile division, that had 247 million monthly active users, mostly thanks to Candy Crush, that continues to crush it. No? I think that was a good one. I'll take it. And to wrap up Activision Blizzard, it has a lot of high-end games and has decent margins. Last quarter was 15%, but that's an outlier low compared to the previous quarters of 23.5 and 24.49. And I also think they'll get their monthly active users numbers in order with Modern Warfare. They have the Battle Pass coming out now, which will entice players to continue to play, max out that Battle Pass. You have World of Warcraft making a resurgence again. But it is an expensive stock. It trades about 25 times forward 12-month earnings, which is called the PE, or price to earnings ratio. And you calculate this by taking the stock price and dividing it by its earnings per share, and thus you get the ratio. This is a very important metric to know. Don't just look at the stock price and say, oh, it's expensive, oh, it's cheap. Make sure you know that price to earnings ratio. There are also different kinds of PE ratios, and I'm using the 12 months, so about a year out in advance, and that's based off the future expectations, but let's not get into that right now. Activision trades about 25 times earnings, and the sector is about 19.25, and so it's very expensive on that metric. Its price to sales ratio is 6.4 versus the sector average of 1.51, so it is very expensive on that metric too, but I do believe it deserves to trade at a premium. It also offers an annual dividend of 37 cents a share. That's a payout of about 17% of its total earnings, and they've increased their dividend 8 years in a row now. I really do like Activision Blizzard. I think it has strong brands, and Especially with Call of Duty, they have the Battle Pass, which is another way to monetize the game without doing the loot crates, which has gotten a lot of backlash. The regulators were thinking about coming in, and so they avoided that by just doing a Battle Pass. Next, we have Take-Two Interactive, whose revenue was up to almost 20% to $539 million. Its net income was down about 37% to $56.83 million. For its first quarter 2020, the revenue was up 39.3% to $540 million, but the net income was down about 35% to $46.28 million. And for the second quarter 2020, the revenue was up 74.12% to $857.54 million. And the net income was up 181% to $71.82 million. And through the three quarters, they've done about 1.937 or about $1.9 billion in sales or revenue, and its net income is $173.93 million. It also has $762.03 million in cash on hand. And what stands out to me is their digitally delivered bookings, which is a subsection of the net bookings, and they define bookings as the net amount of products and services sold digitally or physically during a period, and includes licensing fees, merchandise, in-game advertising, strategy guides, and publisher incentives. This number came out to $695.3 million, which is a 63% increase from this quarter last year, and accounted for 73% of all net bookings. I like this because digital is direct to consumer, and it really mitigates the middleman, which means higher margins for the company. And seeing that account for 73% of net bookings is very encouraging. Also, Take-Two Interactive's Rockstar Games' top franchises don't have yearly releases, which means it isn't capital intensive, rather continuously having DLC, keeping the game fresh, and including microtransactions within the game, which rakes in so much money. And I hate the term, but for lack of a better one, it's like free money for the company. But in the grand scheme of things, they don't have to produce an entire game every year. 2K Sports, and I think it's safe to say now, has officially beaten EA's NBA Live series out in the basketball gaming market. Although that is a yearly release, it still brings in a lot of money through microtransactions for players who want to boost their My Players quickly, people who play My Team. And 2K20 was also the top selling game of the year when it was released. And although the player base complains a lot for very valid reasons about the game, they still play it, they still buy the microtransactions, and they still commit a lot of time into the game. They also have Borderlands, which recently released their third installment that reportedly sold 5 million copies in just 5 days. Take-Two Interactive is another company that trades at a premium to its peers. Its forward PE is 33 times earnings, and its forward price to sales is 4.24. This company, I feel, it may be a little too expensive right here, but it is down around 12% from its $135.70 52-week high. This could be the buying opportunity, but I'm not sure. It still seems a bit expensive up here. And now to our final stock of the video, Electronic Arts. If you look at their fourth quarter 2019, revenue was $1.24 billion, down about 25%, and net income was down about 65% to $209 million. For the first quarter of 2020, revenue was $1.21 billion, up about 6%, and the net income was up about 385% to $1.42 billion. And in second quarter 2020, revenue was $1.35 billion, up about 4.82%, and then net income was up 234.9% to $854 million. Through the three quarters, that's $3.8 billion in revenue and $2.483 billion of net income, and they have about $2.94 billion in cash on hand. The thing that stood out to me was the same thing that stood out to me with Take-Two Interactive, is that EA's trailing 12-month digital net bookings were a record $3.833 billion and up 8% year over year, and now it accounts for 78% of total net bookings. The number of unique Ultimate Team players are up for both FIFA and Madden, 22 and 19% respectively year over year. Sims 4 monthly active users were up more than 40% year over year, and they expect next quarter's revenue to be $5.41 billion with a diluted EPS of $9.57 per share, $5.74 a share of which is expected to be due to a one-time tax benefit. The financials at EA are almost impeccable. The margins last quarter was 63.35%, and it really solidifies the stock because at the time when I was researching it, I didn't own it, but I continuously asked myself, why don't I own this? And then when I saw that the stock was cheap, it trades 10 times forward PE, its price to sales is 5.82, but this stock is very, very cheap. And this was kind of validated when hedge fund McKay Shield grew its 65,931 share position in EA by 5.3%, adding 3,307 shares. But I don't recommend, never invest based off what other people do. Always do your own research. But it isn't all peaches and roses for Electronic Arts. It does have an image problem. NBA Live has failed. The gameplay at Madden is almost or you can really say it's a disaster, but it still has an exclusive contract with the NFL, which will produce sales. And I hope they fix the gameplay and they just add 707s. That's just an idea. Loot boxes, or surprise mechanics, as they call them now, are a problem for the company. And if you look at the Star Wars release, that shows you why. FIFA 20 also has gameplay issues, and to the consumer, it seems like EA doesn't care about them, and that could hurt the company long term. And when you look at each company side by side, Activision Blizzard and Electronic Arts both blow out Take-Two Interactive in terms of top and bottom line. EA is really the most efficient in terms of margins, but Take-Two Interactive does trade a lot higher than both the other companies, so the market is pricing in a lot of growth. Its price to sales is also a lot lower than both of these companies, but Activision Blizzard is also the only one to offer a dividend. Well, there you guys have it. That was more of a bird's eye view of things. You looked at the revenue, the income, the price to earnings, the price to sales, whether offered a dividend, the cash on hand. And then we looked at some of the things that the company had going for it and a few things that may be of concern with the company. Let me know if you want me to do more in-depth analysis of each of these companies, or if you want to look at some of the other gaming companies like Logitech. You have Turtle Beast. There's a lot of different things we can get into. Let me know down in the comment section below if you like this video. Remember, do not buy or sell stock based on someone else's opinion. I am not a professional. Always do your own research. See you in the comment section.